Well, good morning, John. It's good to see you again. And this morning we have the second presidential debate between Kamala Harris and Donald Trump at 11 o'clock our time this morning. But by the time people view this recording, I guess the pundits will have determined who won and who lost. Does it matter to you, do you think, whether the markets are really anticipating a Trump victory or a Kamala victory? Is that going to determine how the markets perform between now and November the 4th?
I just think that the level of uncertainty prior to that, it's almost like if the election happened tomorrow, when you hear who the victor was, we can move on. The next couple of months, I think the level of uncertainty is going to be high, and that just makes it a trading market. Creates volatility, which is good for traders. It doesn't mean anything more than that. I really doesn't think it greatly matters from a stock market sense who the next president of America is. Be interesting to see who makes up the cabinet. That's going to be more interesting because I think in both cases, whoever wins, the quality of the cabinet is going to be more important than ever going forward.
But it does seem that the market would prefer a Trump victory. I've seen just anecdotally a perception that when Trump is doing well, the market seems to be on the rise. And I think that could be explained by the fact that he's very much in favor of corporate tax cuts, whereas Kamala is proposing an increase in the corporate tax rate. Do you think that's fair comment, or it's still a toss-up?
Probably not. It's an interesting argument, but then you're seeing an American market at an all-time high under a Democratic president. So we sort of say, well, if that's happening now, what's going to change going forward? So I look, whilst tax cuts obviously positive for the corporate sector of America, again, I go back to my comment, I don't think it really matters. I think the American economy has an engine of its own, unreliant on the leadership of the country, which is quite bizarre, but that's capitalism for you. That's how it works. So I just sit back and watch it.
John, I did notice this morning, we're recording this on Wednesday morning, that the 10-year Treasury yield is down to, it's in the 3.6s now, 3.64, 3.65. And I've also noticed overnight that commodity prices are particularly weak. It's not just iron ore, which has gone from 120 a ton to 90. It's also the oil price, the copper price. Are commodities and bonds telling us that this so-called soft landing that has been engineered by the Fed might turn out to be a bit more of a hard landing than we're anticipating?
Well, I don't think it's as much to do with the American economy as it is to do with the Chinese economy. And I think we're missing the point, but I keep on making the point that China is heading towards 20% of the world economy in terms of its size. And so if its growth jolts back from 5% back to, say, 2 to 3%, it is reasonably significant for a lot of these commodities. And there's no doubt that China kept on investing in inventories, commodity inventories and metals inventories. There's lots of evidence of that, assuming that, I guess, the government would come through with stimulation and they'd come out the other side quicker than they are. So I think we've probably got a lag effect of excessive inventory build-up, particularly in metals and commodities. The oil slowdown, I think it needs more investigation. I think the transition of the world economy, the Western world economy, away from carbon and oil is happening at a greater rate than people perceive. So I'll leave it at that. So a slowing of the world economy, absolutely. But I think inside that, Australia's economy looks quite strong next year. Even we're going through a flat patch much quicker than the rest of the world, so to speak.
We know that our national accounts are quite dependent on commodity prices. Is this going to make much of a difference? For so many years, the budget was minimizing the iron ore price in order to, give us a positive surprise. Now the reverse might be happening.
Yeah, look, the Australian economy is growing under the strength of immigration and population growth. There's not much else happening, but this is what we predicted, that the Australian economy would be resilient because of that immigration policy, which will drive economic activity for quite a few years going forward. So there's no problem here. I noted in the paper this morning BHP making a claim, because one thing that's happening is the resources sector is not getting any support from the government, and we've seen some recent decisions which are a bit strange. So there is quite a publicity campaign going. I think BHP said they paid their tax they paid last year, their corporate tax they paid, represented 50% of the health budget of Australia. So your point is true. The resources are a significant part of the Australian economy, a particular part of the tax collection by government. At this stage, we're okay because iron ore prices are still above what the budget estimated. So it's not as if we're going to get a shock at this point. But we have to watch the iron ore price. If it dips below $80, then I think we will start seeing some effects on the government budget.
In the meantime, in the last couple of weeks, we've seen increased kind of public finger pointing between the Treasurer and the RBA. What do you make of all of that? I mean, it's just a normal government saying it's not our fault that people are struggling, and here's someone else you can blame.
Oh, look, they're all to blame. And I mean, I've written this in last week in First Links. That's particularly connected to the housing market, which is a botch up. But inflation, and I know we're going to talk about shortly about the oil price, but inflation has been caused by excessive largesse in the monetary policy coming out of COVID. Look, it's easy in retrospect to be critical, but I think the Central Bank of Australia has been on the wrong foot for quite a few years, and even coming into COVID. So the asset inflation we've seen, which has led to housing inflation and obviously led to consumer price inflation, they're all related. I do suggest that RBA has a fair level of responsibility, but also the government. I've said this before, the government has been very lax in holding down price increases. We have a situation in Australia where indexation of taxes and fees and costs and toll roads, it's almost like we like turning up inflation for the benefit of government revenue, and it's that sort of thing I think has got to stop. So I think the argument about excessive expenditure by the government is probably overstated. I think it's just poor fiscal management and poor monetary management. And I make this point, this talk about they should be independent of each other. Why? Why would you have a monetary policy independent of the fiscal policy? It's nonsensical. You need both arms of the bureaucracy to talk to each other and formulate policies either at a time to fight inflation or at a time to stimulate the economy. You don't want them not being on the same page. So I just look at the debate and think it's farcical, and it shows that the politicians of this country just don't actually understand economic policy settings.
You mentioned the oil price, and I noted that the Brent crude is trading below $70 a barrel for the first time since 2021. This is going to have obvious implications for consumers the world over, but particularly those consumers who are going to be voting in the US presidential election in a couple of. What do you say about that?
Well, this is how bizarre economic argument is at present. So in Australia, it would not be. You could probably foresee in the next few months that the petrol price coming down 10 to 20 cents a litre, based on what we're seeing. The fact that this hasn't happened already is interesting, but that's the delayed mechanism. So, as you just said, a decrease of, say, 10% in the petrol price puts extra cash into the household sector. And what's the RBA going to say? Oh, that's feeding inflation. I mean, hold on. The petrol price is coming down, which is driving down inflation. And based on the recent diatribe coming out of the Reserve Bank, if you give the household sector more money, they're going to create inflation. You know, they are bizarrely stupid arguments which don't understand that this inflation cycle is cost-driven. It's not demand-driven at all. And the national accounts just showed that. It's not a demand-driven inflation cycle, it's a cost. Now, we're going to get an interesting situation here where probably both the RBA and Treasury are wrong in terms of forecasting inflation. If the gasoline price in America has dropped from $2.80, this is wholesale, a gallon, to $1.90 a gallon since April. So over 4 to 5 months, there's been a 30% decline in wholesale gasoline prices, which I think will go through to the Bowser. And so there'll be some surprising inflation figures coming out of America in the next 2 months, as you say, prior to the election. We will also see the same probably in the December quarter. And it'll be bizarre if the government says, oh, our inflation policy is working, our fighting policy of inflation is working. They'll claim credit for the oil price going down. So get ready for that bit of nonsense coming through. So getting back to your point, the oil price coming down is going to be supportive of economic activity, put more money back into the household sector at a time when they need that. They need that sort of cash flow injection because they're not going to get it through wages.
Meantime, the ASX has been, let's say, just range trading over the past few weeks and seems to have a nervous edge to it. But the one sector that has really done well is the banking sector. I know we've spoken about this so many times, but CBA hit a new all-time record yesterday, I think $145. And in fact, I noted that Westpac has actually performed even better than CBA over the last 12 months, which is pretty extraordinary. It's up 50%. Do you think that this is all sort of index-driven, or it's
Absolutely
from fundamentals?
No, it's not fundamentals. It's clearly two factors. It's indexing with the proliferation of hedge funds and day traders and long shorts and pair trading, which has just taken over the Australian market. I'd hate if there ever was an inquiry into how much of the Australian trading each day is by hedge funds and day traders and pair traders. I think we'd be stunned. And it leads me to another thought that it's about time we started putting transaction taxes on certain entities rather than having personal taxes. But that's another debate for another day. But the size of the Australian market is being overwhelmed by the weightings to banks against resources. And so, as indexing comes, everyone's saying don't think about investing, just buy the market, buy the index. You are getting an effect on these large cap stocks, no larger than the banks now, as we know. And is it dangerous? Look, I think we've got to be wary about this because, we can't say the money's going to dry up and the indexing is going to stop tomorrow. It's not. But it does create overvaluation bubbles in the market. And, I reflect on it. I go, are we into a new paradigm? And that's dangerous when you start thinking about it. Are the banks now got to be priced differently to when at any point in my working life? So I go back 40 years.
Yeah.
When I joined the market in 82, 83, the P's of a bank were 6 times PE and a yield of 6%. It was pre-franking. And they were raising capital endlessly coming out of the crisis of the 1970s and the inflation cycle. And, there was a recession in Australia in the early 80s. And that's what people got to remember, that banks will burn capital very quickly if we have a downturn. Now, I guess the market is saying that there's no likelihood of a downturn, and I'd agree to that. The interesting thing would be, we saw, and we've got to come back next week and talk about APRA's recent announcement regarding hybrids and capital structures of banks. That was a thought piece put out this week. I've got to reflect on it, and I'll have a view next week. But I do say this, that the banks, are managing their capital, I would say fairly aggressively. Payout ratios are high. Should banks be encouraged to have more capital at this point in the cycle, given the leverage in the household sector? That part of the household sector, a third of households have $3 trillion of debt. I think there's an argument for the banks to have more capital, and that would go against the argument that they're justified at 20 times PEs and plus, and that the market's prepared to buy them on very substandard return on equity. Look, I just think I look at it. If you're a tactical investor, you'd be drifting away from the banks, obviously, looking for the next sector which performs. but the weight of money at present going into that sector is excessive, and it's getting worse. And it's not unlike what we're seeing in America in NASDAQ with those Super 7 or Super 8 stocks. It's the same sort of, but that's where the world's gone. This indexing, default investing is taking over, you know.
John, we've got time for one question. I know that we've noted in past episodes that the government has said that they'll limit international student numbers to 270,000. And yet, over the last couple of weeks, I've been reading and hearing from lots and lots of companies that are involved in either tourism or education. And these are two services sectors that are amongst the biggest in Australia, complaining that this is a terrible decision to limit those numbers. How do you feel on that? What's your thoughts?
Well, I think you know, and I've read a few articles like you have, Paul, and a few letters to editors, and it's interesting. I read one interesting, like if we're 250 odd thousand students come in to be educated, then obviously there's people leaving who are being educated, so that there's flows out and flows in. I thought that got me thinking about it, because obviously we had a period coming out of COVID where there was not many foreign students because of COVID, so there was a huge catch-up which had to occur to rebuild the numbers. And we probably had a shock to the system as that catch-up happened probably a lot quicker than we anticipated, and filled up the universities, and the universities went full throttle again. And they probably wrongly expected that the growth in that student numbers would continue to compound, which it clearly couldn't. And they can't do it for a couple of reasons. One is they couldn't handle it, and the economy can't handle it. Now, whether the government's being excessive, time will tell, but I think they had to put a stop to it because of bad policy, because we are under housed. It's causing significant issues in the rental markets. But against that, it's supporting, as you said, the services industry, because, you know, we seem to have a lack of will in a certain part of the Australian workforce to actually want to work in services. So, you know, these student visas fill the gap. And I made the comment a few weeks ago when I was in Cairns. I mean, so, you know, again, I think we have policy which doesn't consider all the issues. These are big policy issues. This is a big part of the Australian economy now, and it's a big generator of export income, you know, the student payments. So, again, I think there's just not enough thought about constructing economic policy in this country. And it's about time we went to, you know, 5 and 10 year plans across industries to coordinate the economy to all be, you know, running in the same direction, meeting the shortfalls appropriately, you know, pushing back on the overflows appropriately, and getting a stabilised economy. So I think everything we're seeing, Paul, is just bad management. In Australia's way we run, we don't like planning, do we? We don't like planning ahead. It's chaotic.
Well, thanks for those comments, John. I think we will have to leave it there, and we'll expand on some of these topics again next week. So thanks to the audience, and see you next week. Cheers.
Yeah.